Hi, my name is Matt Bushby, and today I'm with the ClearBridge Global Infrastructure team. The ClearBridge Global Infrastructure Income Strategy was specifically built to provide investors with an attractive total return, that is, global inflation plus 5.5% per annum over an economic cycle, built upon the foundation of a 5% dividend yield. With me is Portfolio Manager Charles Hamieh, Portfolio Manager across all of ClearBridge's infrastructure strategies. Charles, thanks for joining us. Why has infrastructure proved such a popular income solution for investors?
If you think about income and what an investor needs from income, they want it to be reliable, they want it to be consistently delivered, and they want it to be protected against inflation. And infrastructure is unique as an asset class because it does all that. By investing in essential services that are regulated or governed by concession agreements, they're able to achieve a very high resilience of cash flow, which translates into very strong dividends, which typically can grow well above inflation.
Let's examine that in a little bit more detail. Property investors sign a lease,
Yes.
which you think would sort of protect the income there. What's the difference between that and the regulation and long-term concession contracts that govern infrastructure returns?
So property really is no different to any asset class because it's subject to competitive supply and demand pressures, and it's much shorter duration. If you think about infrastructure, these are essential services. So water, gas, electricity, toll roads and airports. And they're governed by regulation or concession agreements. And within both of those, there's very clearly defined ways they achieve their return. So think about a utility, a water utility. A water utility is governed by regulation, which allows them to earn a return for all the capex they spend. And that's very long duration, similar to a toll road. What that means is that you have very high predictability of outcome, which has almost no elasticity to economic outcomes. And that enables these assets to deliver much more resilient and predictable cash flows than most other asset classes.
Let's pick up on this point on income stability and resilience of dividends. How did infrastructure as a whole fare during COVID? Clearly, some assets were affected by mobility restrictions, but talking the sector as a whole, what did you observe last year during the COVID period and perhaps even this year continuing?
You're correct. Assets such as toll roads and airports, certainly mobility restrictions meant that there was no users of those assets and there was a significant impact on cash flows and subsequently dividends. We spent a lot of time understanding the financial cushion of these businesses and their ability to operate under extended periods of mobility restrictions. Other parts of our universe, such as utilities, where we're most heavily invested, there was little to no impact. And where there was an impact, there is mechanisms in regulation which allow them to claw back that impact in subsequent periods of regulation.
Let's talk specifically about the ClearBridge Global Infrastructure Income Strategy. As I mentioned before, the target yield of 5% on average through an economic cycle, and this is something that's been achieved over the life of the product, that compares to the infrastructure peer group in investment of around 3.3%. Are we taking on additional risk in order to generate that attractive income?
No, we are not. And what's clear is over most time periods, our risk and return outcomes have been far superior to many of our peers. We've been able to achieve not only a higher return, but achieve our return with a lower level of volatility consistently. And that's a function of a few things. Firstly, our focus on not only understanding the return profile of investments, but also the risk around that return profile. We have a large team of specialists and we spend a lot of time driving down into the long-term drivers of cash flows and dividends and the various valuation scenarios or range of outcomes around those cash flow and dividend scenarios. We also have a proprietary investment universe. So at the very early stage in our portfolio construction, we're thinking about stability of cash flows, stability of dividends, screening out companies which can't offer that to investors.
And when the investment committee is looking to make an investment decision, is it total return or is it income that's the primary driver for whether a stock makes it into the portfolio or not?
First and foremost, the primary driver is total return. We would never invest in a company based on yield alone. So the company has to achieve our total return target, and the secondary measure is an attractive dividend yield.
Turning to the future, we're obviously at a low point in bond yields around the world. Would we expect a rising bond yield environment to have a negative impact on the ability of these companies to pay dividends?
No, we wouldn't. If you think about regulation and what a regulator is trying to achieve with these companies, first and foremost, they're making sure that any changes to a macroeconomic environment, whether it be interest rates or inflation, are passed through to the user of that asset. So fundamentally, there is no impact from rising rates or rising inflation for that matter on the underlying value of these businesses or on their ability to consistently pay high dividend yields.
So what gives you confidence in the future that these businesses are able to, achieve attractive total returns and an attractive and potentially growing dividend profile?
So what underpins these businesses ultimately is their growth in asset bases. So when a utility spends money on growing its asset base, whether it's a water utility or an electricity utility, they do that in a regulated environment where they're allowed to earn a return on every dollar of capex they spend. And quite often, it is that asset-based growth which is more closely aligned to equity outcomes. Historically, that asset-based growth has been between 6.5% and 7%. Now, going forward, the various tailwinds of achieving net zero by 2050 and other drivers, we feel will ensure that asset-based growth not only stays at that level, potentially grows significantly more. And as I said, that really underpins all the cash flow and dividend outcomes from the sector.
Thanks for joining us today, Charles.
Thank you, Matt.
So it's the essential nature of infrastructure assets, the regulation under which they operate or the long-term concession agreements which underpin their cash flows, which separates infrastructure as an income solution from either general equities or property securities. As investors continue to struggle to meet their income needs out of traditional fixed income allocations, the ClearBridge Global Infrastructure Income Strategy could be a fantastic opportunity to generate not only an attractive dividend yield, but very attractive total returns over time.